Over 40% of all real estate millionaires in the United States built their initial portfolios without using a single dollar of their own money. Not a down payment. Not a deposit. Nothing. And most of them did it using strategies that your bank will never tell you about, because banks need you to believe that debt is the only door into real estate. In the next 10 minutes, you are going to discover the exact methods that investors use to acquire properties with zero money down, why these strategies are far more accessible than the financial industry wants you to think, and the one approach that experienced investors quietly use again and again that most beginners completely overlook. We will break down each method with real numbers, real logic, and the kind of clarity that actually helps you take action. Stay with us, because one of these strategies might be the turning point you have been waiting for. Real estate has always been considered the wealth-building tool of the privileged. For most of modern history, acquiring property meant accumulating enough capital for a down payment, typically 10 to 20% of the purchase price. On a $300,000 home, that is $60,000 sitting in your bank account before you even begin. For the average American household, that kind of liquid savings takes years, sometimes decades, to build. The system, as it was designed, kept most people renting while a smaller class of investors compounded their wealth through property ownership. But starting in the late 20th century, creative financing strategies began to emerge, not from banks, but from investors themselves. These were people who understood that real estate's true value lies in leverage, not in the amount of cash you bring to the table. The first and arguably most powerful strategy is seller financing. This is where the property owner essentially acts as your bank. Instead of you going to a financial institution and securing a mortgage, the seller agrees to let you pay them directly over time. You make monthly payments, often at a negotiated interest rate, and you take possession of the property immediately. The seller gets a steady income stream, you get the property without a traditional down payment, and no bank is involved in the transaction. This works particularly well with sellers who own their properties outright, meaning they have no mortgage, and who are motivated to sell quickly. Retired landlords, estate sales, and long-term owners who want passive income are ideal candidates. In many of these deals, the only upfront cost is closing fees, which can sometimes be negotiated into the loan itself. Seller financing represents one of the cleanest, most straightforward paths into real estate ownership with minimal capital. The second strategy is the lease option, sometimes called rent-to-own. Here you lease a property from an owner with the contractual right to purchase it at a predetermined price within a set time frame. A portion of your monthly rent payments are credited toward the eventual purchase price. The beauty of this structure is that it locks in today's price while giving you time to build the funds needed to execute the purchase or to find a buyer and assign the contract for a profit. Many investors use lease options not to eventually buy the property themselves, but to control it, sublease it, and generate income in the meantime. This is a legitimate, widely used technique, and in hot markets, locking in a purchase price while values climb can generate significant equity before you ever formally take ownership. But here is what nobody talks about. The strategy that consistently produces the fastest results for new investors is not seller financing, and it is not lease options. It is wholesaling combined with strategic relationship building. Wholesaling means you find a deeply discounted property, secure it under contract, and then sell that contract to a cash buyer for an assignment fee typically between $5,000 and $30,000 per deal. You never own the property. You never need financing. You simply serve as the connector between motivated sellers and ready buyers. The Federal Reserve reports that distressed property sales account for nearly 11% of all residential transactions in any given year. That is an enormous pool of opportunity for anyone willing to do the legwork of finding these deals before they hit the open market. Now let us talk about private money lending and partnerships, because this is where the game truly changes for serious investors. A private money lender is simply a private individual, not a bank, who lends you capital for real estate deals in exchange for a fixed return on their investment. These are often people with retirement accounts, inheritance money, or business profits sitting in low-yield savings accounts. By offering them 8 to 12% annual returns secured by a tangible asset, the property itself, you create a compelling alternative to whatever their bank is currently offering them. The investor brings the capital, you bring the deal and the management. Profits are split according to your agreement. This structure has funded thousands of real estate acquisitions with $0 from the operating partner. Hard money lenders operate similarly but are more formalized. They are typically companies or experienced investors who lend based primarily on the value of the property rather than your credit score or income. Hard money loans are short-term, usually 6 to 18 months, with higher interest rates, often 10 to 15%. But they are fast, flexible, and do not require the traditional down payments that conventional mortgages demand. Many investors use hard money to acquire and renovate a property quickly, then refinance into a conventional loan at the improved property value, a strategy known as BRRR, buy, rehab, rent, refinance, repeat. Done correctly, the refinance returns most or all of the original investment, effectively resetting your capital to zero while you retain the asset. Government-backed loan programs are another avenue that gets far too little attention. The USDA Rural Development Loan Program offers 100% financing, meaning zero down payment, for eligible properties in qualifying rural and suburban areas. The FHA loan program requires as little as 3.5% down, and that down payment can legally come from gift funds or approved down payment assistance programs, effectively bringing your personal contribution to zero. VA loans, available to eligible veterans and service members, offer full financing with no down payment and no private mortgage insurance. These are not obscure loopholes. These are federally supported programs specifically designed to expand homeownership access, and they represent billions of dollars in financing that is available to qualified buyers right now. What makes all of these strategies work, and this is the analysis that separates investors who succeed from those who simply read about investing, is not the technique itself. It is the pipeline. The investors who consistently acquire properties with little or no money down are the ones who have built relationships before they need them. They know private lenders before they have a deal. They know motivated sellers before their properties hit the market. They know cash buyers before they lock up a contract. Real estate is, at its core, a relationship business wearing the costume of a finance business. Every strategy we have discussed depends on finding the right counterparty at the right time. That happens through relentless networking, direct mail campaigns, driving for dollars, attending local real estate investor meetups, and building a reputation as someone who closes deals and keeps their word. The data supports this clearly. According to the National Real Estate Investors Association, investors who actively network within their local communities close an average of 3 times more deals per year than those who rely solely on online platforms and listing services. 3 times. That is not a marginal edge. That is the difference between 1 deal and 3 deals, or between 3 deals and 9. There is also an important risk dimension to understand. Zero money down investing is not zero risk investing. Seller financing, lease options, and private partnerships all carry legal and financial obligations that must be honored. Entering a deal without thorough due diligence, inspections, title searches, market analysis, exit strategy planning can turn a promising opportunity into a costly mistake. The strategies themselves are sound. Before you go, if you learned something valuable today, hit that like button right now. Subscribe to Realty Pulse for a brand new video every single day. We will see you in the next one.